have been covering some of the best ETFs for maximizing dividend income, and majority of them use option strategies like covered calls to generate exceptionally high yields, making them ideal for income-focused investors and retirees. Now, one of the most attractive aspects of these ETFs is not only the high level of income, but also the frequency of dividend distributions. The most frequent dividend distributions from ETFs that I've covered were on a monthly basis. And for retirees and income investors, this can be a dream investment because the more frequent the dividend distributions, the more investors are able to dollar cost average and capitalize on compounding growth. And now there's a new series of ETFs that distribute dividends on a weekly basis, completely transforming passive income generation for dividend investors. Weekly passive income generation can create a game-changing boost for portfolio returns. And there's one particular ETF that stands out the most. And with a dividend yield of around 30%, it has been gaining a lot of attention. And the craziest part is that the ETF does not own any shares. And this brings me to QDTE, which is the Roundhill Innovation 100 Zero DTE Covered Call Strategy ETF. QDTE was established on March 7th, 2024. Now, QDTE has an expense ratio of around 1%, which is very high, but you'll understand why it's so expensive in just a bit. Now, if we're going to compare this ETF to any benchmark ETF, it has to be the QQQ, because its option strategy is on the NASDAQ 100. Just looking at its performance relative to the QQQ, the fact that it's actually been able to outperform is very intriguing because most high-income covered call ETFs on the NASDAQ 100 will typically lag behind. Now, when you look at the fund's holding breakdown, you see no shares of stock, but instead you only see NASDAQ call options and treasury bonds. The treasury bonds provides extra income. So let's get to the main question. How does this ETF work, and how is it able to generate a 30% annual dividend yield and distribute it on a weekly basis? To put everything in very simple terms, this ETF is essentially a poor man's covered call strategy on the NASDAQ 100 wrapped in an ETF. But what's interesting is that the fund managers are selling zero DTE call options on the NASDAQ 100 every single day. So let's break that down. The poor man's covered call is a strategy that mimics a traditional covered call strategy, but it requires a lot less capital. Very important to remember. And the way it works is very simple. Instead of buying and holding shares of stock and then selling calls against them like most covered call ETFs, the fund purchases a long-dated in-the-money call option, otherwise known as a LEAP. So for example, instead of buying 100 shares of the QQQ, I would purchase a call option with an expiration date of 1 to 2 years. And this essentially acts as a substitute for owning the stock. And when you look at the fund's holding breakdown, you see that the call options on the NASDAQ 100 are all expiring in 2025. Now, aside from ETFs, when it comes to portfolio construction, I like to complement my allocations with individual stocks as well. One of my favorite tools for this is ProPix AI. This feature builds model portfolios based on different strategies, and it is designed to outperform benchmarks. And there are many powerful portfolio options you can choose from, such as Tech Titans, Warren Buffett's Top 15, Healthcare Heroes, Small Cap Sprinters, or the S&P 500 Value Portfolio. Every portfolio includes a detailed breakdown of each stock's financial health, earnings, cash flow, valuation, and even timestamps of when the position was opened or closed. I'm very excited to share that Investing.com has officially launched their Black Friday early bird sale where you can get up to 55% off their plans. And if you use my link, you will get an additional 15% off on top of that, which means you can get up to 70% off. InvestingPro gives you access to a massive database of global stocks and ETFs, which is backed by deep financial data, research tools, portfolio analytics, and both technical and fundamental insights. You'll also find portfolios from top fund managers like Ray Dalio and Warren Buffett, which you can analyze or even replicate directly inside the platform. As always, past performance is not indicative of future results, and this is not financial advice. I am simply sharing one of the tools I personally use to enhance my own research. Another one of my favorite features is Warren AI, which is like their version of ChatGPT, but with access to a real financial database. So when you ask it a question, the response isn't just surface level, it is backed by actual data and analytics from their system. There's a lot to explore inside the platform, and if you'd like to check it out, you can use my link or code Victoria Media to get an additional 15% off, for a total savings of up to 70% off. There are two very important factors that we have to discuss here. Number one, these LEAPs are purchased deep in the money. So the strike price of the call options that are purchased as LEAPs are well below the current trading price of the Nasdaq 100. And there are several reasons the fund does this. For one, deep in the money leaps typically have a delta that is close to 1. And delta is an options graph that represents how much an options price changes in relation to the underlying asset's price. So the closer the number is to 1, means that the option contract is moving almost dollar for dollar with the Nasdaq 100. This makes the price fluctuations behave very similarly to owning the stock itself. But like I said, it requires a lot less capital. But remember that this ETF is purchasing these leaps on the Nasdaq 100 index, so there are no shares involved and everything is settled with cash. Also, deep in the money call options experience a lot less time decay, otherwise known as theta decay. And theta decay is what decreases the value of an option contract as it approaches its expiration. And the closer and closer an option contract gets to its expiration, the more pronounced the effect of theta decay becomes. So for an ETF that wants to replace owning shares with leaps, you don't want theta decay to be a problem. Now circling back to QDTE, the fund managers have 3 sets of leaps, each expiring at a further date in order to avoid the impact of theta decay, but to also maintain exposure to the underlying index. Now, the reason the fund managers are doing this is likely because they want to have more capital available to sell call options so that they would be able to generate a lot of premium income. Alright, so now that you understand what leaps are, we have to talk about the fund's covered call strategy. This fund is selling 0 DTE call options on the Nasdaq 100. And all this means is that the call options have 0 days to expiration. Now, the most important thing to keep in mind about 0 DTE call options is that the fund managers are trying to capture premium income on a daily basis. And this is very different from typical covered call ETFs like JEPQ, which sell call options that are 30 days to expiration. This is why the fund is able to distribute dividends on a weekly basis, because it is collecting income every single day. And this also explains why the fund's expense ratio is so incredibly high, because fees for daily option trades can add up. So why would they do this? Well, I think there's 2 major benefits, and this is where I want you guys to pay very close attention. The first is to capitalize on more upward momentum. You see, when the fund managers are selling these call options every day, they are only trading when the market is open, from 9:30 a.m. Eastern to 4 p.m. Eastern. That means that in pre-market and after hours, the fund does not hold any covered calls. And what this does is it allows the fund to capitalize on any major movements within the markets before they open. So if the markets suddenly gap up by 2% in pre-market, the ETF will be able to participate in that. And this sets it apart from all other high-income ETFs. Typical covered call ETFs sell options with 30 days to expiration. So those funds have already determined their total appreciation ability for that month, which means they could miss out on sudden upward movements if the markets appreciate beyond their cap. But QDTE does not have to worry about that. And this is the main thing that I really like about the strategy. Now, the second benefit of selling 0 DTE call options is the ability to capitalize on volatility. When you look at the fund's description, it says the strategy aims to take advantage of the potential mispricing inherent to the short-dated options market, where volatility may be overpriced. You see, options have a positive correlation with volatility, and this relation is called vega. Now, volatility can rise in a single day, but stay low for the remainder of the month. And typical covered call ETFs like JEPQ won't be able to capitalize on that sudden volatility spike because their options are purchased 1 month in advance. And the amount of premium income they're able to collect is decided at the beginning of the month. But QDTE is able to capitalize on volatility every day, changing the amount of premium income it collects on any given day, giving it the ability to capture more premium income on those days, which in turn cushions downside volatility. And you could see that exactly happened right here where QDTE outperformed the QQQ. And remember, this was at a time where volatility was very high, not to mention during a Volmageddon where the volatility index spiked over 160%. And now that we've talked about the good aspects of the ETF, we also have to talk about the negatives. To begin, the fund's performance is essentially dictated by a day trader. The fund manager is choosing where to sell these call options every single day, and depending on his decisions, the ETF will be able to accumulate a certain amount of premium income. Now, another thing you have to understand is that daily expiring call options don't have that much premium income to begin with. And unless there's extreme volatility in the markets, I really don't think that premium income will make much of a difference in the fund's ability to use it to cushion downside volatility. And looking at this portion of the chart where QDTE fell exactly in line with the QQQ, the option income barely made a difference because volatility wasn't exceptionally high. And this is a problem. At a time where the markets could undergo downside pressure, Without a significant rise in volatility, the call options aren't really going to cushion the downside by that much, but the leaps are slowly going to deteriorate. And because they own leaps as opposed to actual stock, the changes in those prices could start to exceed the changes in the actual stock price, especially as it approaches expiration. But again, the ETF holds 3 sets of leaps in order to minimize the effects. However, it is important to keep in mind that over the long term, this could potentially reduce overall returns. So overall, this means that the fund's ability to mitigate downside volatility isn't that good if it's a gradual decline without significant volatility. Now, another downside to daily expiring call options is the inability to capitalize on sudden market recoveries. Like I said, the fund manager is deciding where to sell these call options on a daily basis. So there really isn't much room for error. And the worst part is that if the market has a sudden V-shaped recovery after the call options have been sold, then the fund will completely miss out on the entire recovery heading into market close. So just like any other covered call ETF, this ETF will miss out on the rally of the QQQ. And you can see that right here where the ETF underperformed the QQQ by 4%. Now, there are 2 other downsides to this ETF. For one, it's very expensive. But the worst one is that the fund suffers from heavy NAV depletion. When you look at the fund's NAV, you see that it has already fallen by almost 10%, and the reason this is happening is because the fund's dividend yield is eating into the fund's NAV. So the 20% yield doesn't mean much to me because I can clearly tell that a huge chunk of it is coming out of the fund's NAV. In my opinion, the fund managers are much better off cutting the dividend yield to 10% in order to preserve NAV and make it a more attractive investment. So overall, here's my verdict. The fund's strategy is able to capitalize on more upward movements when compared to other high-income ETFs like JEPQ, only if the fund manager is successful in their daily covered call strategy. But it will still underperform the underlying index in a bull run. It seems like the only time the strategy is actually effective at minimizing the downside is when we have insane levels of volatility. The premium income on those daily expiring call options will be very juicy, and that is what will be able to minimize the downside on that particular day or week. The volatility in July and August is the perfect example, but we don't see that happen too often. Now, on regular days where the markets could sell off, I don't think that you're getting very much downside mitigation. Remember, high-income ETFs have to serve a purpose, and that purpose is to generate high levels of income but minimize volatility of a portfolio. And with this ETF, you will underperform the underlying index, slightly outperform at times when there's significant volatility, and be charged 1% annually for it. But of course, this fund is still very new, so we shall see what happens. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit the thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.